Good morning. This must be working because I had some good mornings back. So my name is Vivek Chaudhary. I'm Dean here at the Daniels College of Business. And it is a pleasure to welcome you today to the second event in the Burns Leadership Series and to introduce our distinguished guest for today. He told me it was okay if I kept his intro short, but he's done so many good things that I'm still going to have to go through some of this. So please allow me to read the bio for our guest for today, Douglas Duncan. Douglas G. Duncan is Senior Vice President and Chief Economist at Fannie Mae. He is responsible for forecasts and analyses of the economy and the housing and mortgage markets. He also oversees strategic research regarding the potential impact of external factors on the housing industry. Under his leadership, Fannie Mae's Economic and Strategic Research Group earned the 2022 Lawrence R. Klein Award for Blue Chip Forecast Accuracy regarding their industry-leading work over a 4-year period. In both 2015 and 16, Duncan and the ESR Group won the NABE Outlook Award, presented annually for the most accurate GDP and Treasury note yield forecasts, becoming the first recipient in the award's history to capture the honor 2 years in a row. Named one of Bloomberg BusinessWeek's 50 most powerful people in real estate and Inman News' 100 most influential people in real estate, Duncan is Fannie Mae's source for information and analyses on demographics and the external business and economic environment. Prior to joining Fannie Mae, Doug was Senior Vice President and Chief Economist at the Mortgage Bankers Association. He received his PhD in agricultural economics from Texas A&M University and his BS and MS in agricultural economics from North Dakota State University. And I think everyone has just one question in mind, which is, what's going to happen to the real estate? But Doug, thank you so much for being here today, and it's my pleasure to welcome you.
Good morning, everybody. Thank you, Dean Chaudhary. My name is Vivek Shah. I'm the director of the Burns School. The leadership series, we do things a bit differently. We don't have Doug giving a talk. We make it interactive. We have a set of questions that I'll ask him, so it's a Q&A, a list of questions pertaining to the economy, interest rates, and of course, real estate. And then after we end those question answers, we'll open it to the audience. So please be prepared with the questions. And we just spoke briefly. So we'll have to improvise a little bit based on today's morning's report, as some of you may have read. So we'll get started, Doug, if you're ready.
You bet, absolutely.
So like I said, first of all, Doug, welcome to our campus.
Thank you. It's great to be here.
Yeah, I've known Doug for a long time, since my days at University of San Diego. That's when I first met him. And Doug also was one of our speakers at a conference at my previous university. So, you know, at that time, I already, when I was moving here, I told him, we'll bring you on campus. And he said, definitely just give me 6 months notice because that's the kind of the lead time he needs to, because of his talks across the country. I have the questions, but there's one question that's now top. As you saw in the morning report, the GDP grew at almost 5% annualized. Interest rates are high, 22-year high. So that imbalance, so to say, how do you explain that?
Yeah, it's there's various things said about forecasting. For example, like if you're going to forecast often. If there's 3 rules to forecasting. If you give a date, don't give a number. If you give a number, don't give a date. And then if you get it right, don't look surprised, which the third one's the most important. So we've seen it coming over the last couple of months. You can see the ramp up in activity. I think it's a combination of a couple things, which we think will also fade. One of them is the consumer has been stronger than expected. And in fact, in his last press conference, Chair Powell referenced to that. That was actually the only thing that he referenced when he answered a question with regard to the strength of growth was, well, the consumer has been more resilient than we thought. The other thing that's going, and I'll come back to the consumer in a moment. The other thing that's going on is the amount of subsidy delivered through the Infrastructure Act, the CHIPS Act, and the Inflation Reduction Act is at least double what was scored in the legislative process. So there's a huge push in the construction. For example, I was speaking with somebody in that makes cement in Georgia, and they're like, well, we're not really worried about the housing space because we can't possibly keep up with all the structure that we're doing in the commercial space. So those three things are certainly a boost. On the consumer side, there's a series of things. We made a massive transfer of income to households where households did two things with it. One is they paid down debt, so credit card balances went way down, which gives them powder to support spending by running those balances back up, and they are doing that. They also saved a lot of it. They have been spending quite a bit of that savings. They also got something like a 7% boost in Social Security, the inflation adjustment of Social Security. They also, with the employment being as strong as it was, as it has been, there's the continued income earning across the economy at very low unemployment rates. So consumers have had a lot of power. Then you add to that the fact that lots of them refinanced their mortgage from 5% down to 2.5%, and there wasn't a whole lot of cash taken out. It was mostly rate term refinancing, which lowers their monthly payment. So they have all these compiled pieces of benefit to their disposable income, and they've been stronger than we anticipated because we didn't properly add all those things together and underestimated their willingness to continue to support consumption.
Great. So now coming back to the list of questions, the R word or the recession word has been used at least for the last 1 year, although the frequency of that and the sentiment on that has gone down significantly. But there are still some concerns. So what are your thoughts on such an occurrence in 2024?
Yeah, in April of 2022, we put into our forecast for 2023, in the third quarter, which is the current quarter we're currently in, that there would be a mild recession that would start. Obviously, that's wrong. So over the course of the next 12 months, as we saw this consumer build taking place, and we saw those pieces of legislation and what was going to work in, we moved that out to the first half of 2024. The most recent Fed forecast went from their 2 quarters ago, their summary of economic projections was pretty close to flat for this time period. Then their most recent summary of economic projections had them move it up to what's called a soft landing. To us, if you look at our current forecast, you'll see that a mild recession is almost the same as no recession, but no growth. So why would we think we'd go from 4.9% GDP annualized to no growth? Well, you're all well aware of the rapid and significant rise in interest rates, not just the initial Fed tightening, but in the last month to 6 weeks, another dramatic increase in rates. We don't think in that short of a time period that after a decade of real interest rates that were close to zero, that there won't be shocks, whether it's at the household level, and they will exhaust all those resources they have built up to support consumption, whether it's a business model in the business sector that was predicated on very low interests, and when their credits roll over, it'll be at a much higher cost to them, and that will hit earnings. That combination of things we think is going to lead to a significant slowdown. Today, if you're going to forecast and think about rates, you have to make a decision about how much of the rate rise is a function of stronger than expected and future expected growth versus this massive amount of public debt that we brought in, because we took all that private debt and transferred it to public debt with the stimulus spending that we did. So now we have this huge mountain, World War II level of debt to GDP that has to be financed. And is the rising rate in significant part investors telling us that they're going to require higher yields to fund all of that debt? So you kind of have to make a decision. We're more in the latter camp than in the former camp.
And I know, Doug, you have certain slides. Anything on the economy, the GDP that we've been discussing that you want to share?
Let me see if I can. I grew up on a farm, and my dad used to say, if it has more than 2 moving parts, don't call Doug. So this, I think, has like 3 parts, so we'll see if this can happen. This is probably all of your careers in interest rates. So if you started in the business world before 1978, I'll exclude you. But anyone else, this is the history of nominal interest rates, both the 30-year fixed rate mortgage and the 10-year treasury. So about 5 or 6 years ago, we started a series of conversations with leaderships of firms where we would say, we think from a risk management perspective, you should be thinking about whether you have the expertise to manage your company in a rising rate environment because you have no experience in that. And perhaps even on your board of directors, you may have no one with experience in what has to be done to manage in a rising rate environment. We feel pretty good about that claim because there were some banks recently that you're well aware of that did not appropriately address the question of what are the risks in a rising rate environment. So most recently, you can see the upturn. That's the Fed tightening that's taken place since the middle of last year, and so that experiment is being run. What I was saying earlier is the experiment has a ways to run because many companies locked in for some time period very low interest rates, but when those interest rates on that debt roll off, they're going to refinance into a much higher rate environment. So the question is, what are they doing about risk management for that point in time when they're going to see that rise in credits? I was in New York talking to a New York Times reporter, and I said, I have not seen any of the articles you were writing 3 or 4 years ago about zombie corporations, which was companies that were profitable, but only because the cost of debt on their on their income statement was so low that if rates moved to something more normal, to long-term interest rates, many of those companies would be in trouble if they hadn't appropriately hedged for that.
Great. All right, shifting to a little bit on the employment side, what employment statistics does your group look at while evaluating the economy? And then the second part to that is which sectors are you seeing that are seeing an expansion and which ones are contracting in the last year or so and forecast from those?
Well, I'll quote Chairman Bernanke from a meeting I was at where he was asked, what keeps you up at night? His response was, everything. So in terms of what we watch in employment, we watch everything, but things that are more important to us are obviously the level of employment, not just unemployment, but the level of employment, the level of part-time employment and the direction of change in part-time employment. We look at the job openings, but more importantly at job quits. So why are some of those things that we look at? Obviously the number of workers, is it growing, is it not growing? The unemployment rate can rise because people are entering the workforce but not finding work. So it's not necessarily a suggestion of losses of jobs, but it represents the lack of growing availability of jobs. The part-time piece we watch because if firms are concerned about the future, they may bring on part-time work because they're not confident that the production is going to be supportive of full-time commitment to employees, so we watch the direction of that. And the quits we watch because people don't quit jobs unless they're confident they can find another job to replace it, which is better for them. So the openings we don't follow as closely because many, particularly small businesses, always have openings for the right person. So they may be advertising some positions that are open, but they're not searching hard, but if the right person comes along, they will add that to their pool. So that's kind of how we look at the employment side of things. And I'm sorry, you had another part of your question?
Yeah, what sectors are you closely watching in terms of expansion, and those that you're watching that you're seeing some contraction?
Right. So we are a services-based economy today. 70% of employment really is related to services in some way. So we think about the difference between what's going on in the services sector, and there are many parts to that, versus the goods sector. And how do I describe this? One of the questions that we've asked is, particularly given the GDP number this morning, I think is relevant, is the U.S. economy as interest rate sensitive as it used to be? So it's the goods sector that tends to be more interest rate sensitive. So we're thinking about housing, which will be something we'll talk about here. Clearly, it's interest rate sensitive. So is things like industrial production or automotive manufacturing, things like that. You see a quick response to those when interest rates change. You don't see as quick a response in the services sector. So one of the things that we observed in at the outset of the pandemic was the job losses were primarily in the services space. But from our perspective, we focus on housing. So what did that mean for us? Well, the homeownership rate of people that are in the services sector is only about 40%. It's salaried workers that buy houses, by and large. So the PPP program was very effective in protecting jobs, and with all the income transfers that took place, it really stoked the demand side. I know we'll come back to that. So other things that we're watching right now is we have under this administration, we have a very explicit move to industrial policy. In fact, one of their senior people gave a speech at the Brookings Institute stating that fact. We believe that at this time, industrial policy is appropriate. It has a kind of a checkered history in the past because government's not necessarily as good at investing as private sector is. So we've got a big experiment underway right now through those three things that I mentioned. But most economists would tell you infrastructure investments, if it's about airports and ports and highways, those are good long-term investments that you can capitalize because they reduce the cost of the distribution of goods and services. So you won't get much argument across economist groups about the value of infrastructure investment. The other two, the CHIPS Act, the argument for the CHIPS Act is that we are heavily dependent on Taiwan for a subset of very key components for a number of things that are valuable in the U.S. economy. We'll talk about the risks related to Taiwan, Israel, Ukraine. These are things that we're having to think about as well. So remains to be seen whether that investment will pay off. I think it's understandable why the argument's being made for that. We'll see whether that's effective. I would note that the fact that Exxon made a big investment in the development and delivery of carbon-based fuels, and then Chevron did the same thing within a month of Exxon, that we would take as a signal that the degree of heat behind ESG and related investments there is becoming more realistic about how long this is going to take and all of the changes that will impose costs on the economy as those changes take place. So those are some of the things that we're watching from the big picture, and I know we're going to talk about housing, so I'll
Because, I mean, we can talk about it right now because you did touch upon how interest rates impact housing, right away. But we have not seen that. Interest rates have gone up, housing prices have been very resilient. What's going on over there? Because that was the whole reason for those to see some kind of shock in housing prices, but affordability is becoming more and more of an issue despite interest rates doubling in the last 1 year.
Right. Excuse me. Let me take a quick sip here. Or as my father would say, wet my whistle. You grew up on a farm, you get all these corny sayings that you have to repeat to your children, and then, it's like, becomes dad jokes and all that. I mentioned the income transfers. We did a measurement while those transfers were underway, and we looked at a family of 3 whose income was under all the caps, so they received all the phases of transfers. They would have received $11,000 of cash. Let's suppose they had a bit of savings, they combined that $11,000 cash, and they had good credit, they could get a 3% down mortgage and buy a $380,000 house. So not everyone did that, but a significant component of people did that. And so what you saw at that time frame was if in any market you divided that market into thirds in terms of price, scale all the prices, top third, middle third, bottom third. The bottom third price appreciation was twice as fast as the top third. So all those transfers were a component of enabling the millennials in particular to enter the first-time buying category. And most of them were in the salaried category, so they also had the benefits of the PPP potentially to support the demand side of the curve. At the same time, they are, by the way, the biggest generation, bigger than the boomers. So you had the boomers aging in place, doing exactly what they said they were always going to do. And during the pandemic, the boomers learned something, that if they had an iPad, they could get health care at home. Call the doctor, linked up with the doctor electronically. I did that myself. I had a little skin issue. She said, hold the iPad over the spot. And I'm like, yeah, looks like things are going well. The fact that you can do that lengthens the amount of time you can stay in that house and receive health care. So we've augmented the desire of the boomers with more capabilities of the boomers to stay in their houses longer. So that's a big chunk out of the supply side of the housing market. Then the Gen Xers never get any airtime, so I've been giving the Gen Xers a little airtime. They're the ones that locked in 2.5% to 4% mortgages. So they're not going anywhere anytime soon. And by the way, we have a blog up on the website. One of the things that we do in our group is we will read headlines and then ask, do we believe that or not? And so we read a bunch of headlines about lock-ins. So we actually surveyed 1,000 people out of our portfolio that meeting all the population distribution characteristics and asked them, are you locked into your home because of the interest rate, or are there other factors that are going to change the decisions you make about where you live? Turns out other factors combined with interest rates the most important thing. So the Gen Xers were at a place in their lifestyle where making a move made some sense in terms of schools and things like that. The pandemic accelerated that because now there was a safety issue, and the response of businesses accelerated that because they told you could work from home. Then the Fed has conducted in monetary policy an exercise to bring rates down to historic lows and take volatility out of the market by building a portfolio. All these factors came together, and the Gen Xers like, it makes a lot of sense to us. So when we surveyed them, it's not just the interest rate change, but it's this combination of policy issues and economic issues And we think that still has a ways to run, particularly that last part that I mentioned about letting people work from home. And there's some adjustments still underway in that. I don't know if that, hopefully that makes some sense. The blog is up on the website. By the way, we have a whole bunch of stuff that we do is up on the website. There's no paywall or anything. You can go on there and download anything that you want out of that work.
So we talked about employment, the economy. In terms of another thing that has been happening was being the inflation and the measures. So if you break down inflation into specific categories, which one of those have been consistently high in the last year as the Federal Reserve tries to bring it down? So if you could break those components of that, and which of those been of concern have been consistently high?
Sure. When the Fed came out and first said that inflation was transitory, I keep the Oxford English Dictionary next to my computer, which I assume you all did the same. No? So I looked up the word transitory. The first definition is not permanent. Now that's a pretty big hole to drive your truck through. So on those terms, life is transitory, right? So we didn't believe that. We did believe there were temporary bottlenecks in the distribution system because we have a global system of supply chains. And so we saw both the pandemic and geopolitical risks as disrupting some of those supply chains, but we also viewed that part would be pretty short term, and the poster child there is all the ships you saw off of Long Beach lined up to come in. That line's gone, all that, and it went away pretty fast. But we said this is also going to lead to a restructuring of global supply chains, and that's time-consuming and expensive. We also said if we're going to decarbonize the economy, that's also time-consuming and expensive, and the Fed is going to have to lean against that. So they did, and they moved rapidly to lean against all that. That's not over. That's why they're going to the 2% level, and they're probably going to stay at the 2% level when they get there. It's going to be tough. Rates are going to be higher on a running rate than they were during the stages of the pandemic. But many of the components, particularly in the goods sector, have come down in terms of their contribution, the rate of their contribution to inflation. Not so much housing. That's the one component, and the labor market is the second component that the Fed has got most of its attention focused on today. So the housing piece is gradually coming down, and I'll get to the reversal. But the year-over-year measures now will show some upward pressure from multiple components, not just the housing piece. The labor piece, they're watching wage rates. Here's the challenge for them in the wage rate. I had an Uber driver when I was going to the airport in Florida, and he was angry about inflation being so high. And I said, well, it's come down from 9% to 4%. He didn't believe that. I said, is this what you're thinking, that your wages have not risen appreciably, but prices went up and stayed up? And he said, yeah, that's the problem with inflation. I said, okay, so you're confusing the rate of inflation with the price level subsequent to that pace of inflation. That's broad-based among consumers in the economy. They recognize, yeah, maybe the way that you measure it and the pace of change might have slowed, but prices haven't come down and our incomes have not risen to the level to accommodate the same share of our budget. You can look at that by taking the dollar value of goods and services and charting that, and then I don't have that chart in the deck, but look at the number of units of consumption. It's flat for the last 2 years, even though the dollar value has risen. That tells you why consumers have that frustration that they have. So the housing piece started to come down. Everybody, including ourselves, forecasts some decline in house prices starting in the second half of 2022. Our forecast, I think, initially was over a 2-year period, we would see about a 10% decline. I got in trouble with the regulator in July of 2022 because in my commentary, I said that the housing market fell off a cliff. They didn't like that. They said, we don't like you using those words. And I said, well, when you look at the data, what does it tell you? They said, well, just don't say it fell off a cliff, even though it fell off a cliff. So it basically stopped. And that quarter, national average house prices did fall, something around the neighborhood of 2%. But in that was third quarter, of 2022. Fourth quarter, it was flat. And we were like, that's interesting. And our estimate this year, over the course of this year, is that house prices nationally will rise about 6.7%. So why did that happen? It happened because the boomers are aging in place. The Gen Xers have locked in their home for a substantial time period and are going nowhere. And there's a lot of millennials that would like to buy houses. And they're salaried, and they have 2 incomes, and they're positioned in terms of lifestyle and housing demand to buy houses. And they're also cognizant that when the Fed gets to 2%, they will cut rates and they can refinance those homes at lower interest rates. So they're like, we've got the income now to qualify, so we'll buy. When the Fed eases, we'll refinance and improve the financials of it. So the question is, how long will that take to get to the point where the Fed declines? So here's recently, I'm always looking for teaching examples. A lot of what I do from my perspective is try to teach business leaders how to read data. And so recently there was an excellent textbook example of the speed with which markets can respond to changes in the environment. So when the Fed was tightening and mortgage rates the first time passed 7%, the MBS market kind of froze up because fixed income investors did not believe that a mortgage-backed security backed by 7% mortgages would be there a year or a year and a half later when the Fed has cut interest rates by 200 basis points. So that all those MBS would run off because people would refinance the underlying collateral. So the market sort of froze just briefly. Within a week, you saw mortgage companies and builders offering 2% buy-downs of interest rates within a week. It was amazing how fast that happened. So why would builders who tend to build for move-up buyers offer interest rate buy-downs? Because they recognized the marginal growth in their business was first-time buyers who couldn't buy existing homes because boomers and Gen Xers wouldn't make them available, had to go to the new home market. And the problem of a first-time buyer is not granite countertops and finished basements, it's down payments and financing. So you could give away 2%, a part of your margin, to lower that interest rate by 2% and get those first-time buyers into a house. It was amazing how fast that moved and very explainable from the fundamentals of supply and demand and financing. So you can see how the housing market has not normalized, because you can look at the share of total home sales today that are new homes. It's much higher than average, which shows the lock-in for the boomers and the Gen Xers. And then if you look at new home sales and look at the share which are to first-time buyers, it's also much higher than average. So that lack of existing supply has driven them to the new home space, so the builders had to adjust to a significant part of their builder coming to the entry-level buyer. That was a cultural change for the builders as well, because typically if you go back to when people would go visit their office, their sales staff is tuned to selling you attributes, right? Because you had financing, because you had equity from the other house that you were going to sell. This is not an environment where attributes are the sales, it's the financing mechanism. It was really, Okay, I'm an economics geek. I found that really fascinating. Sorry. Don't come to our cocktail parties.
So staying with the topic of inflation, the target rate has always been 2%, and I've read that there are some economists, and there's some conversation that in the last maybe decade or slightly more, the targeting 2% is not the way to look at it because that rate is much higher now. So the benchmark should be not 2%, but maybe 4% or something else. What are your thoughts on that?
Well, I have a disagreement with 2%, but my disagreement's in the other direction. So one of the things that I think makes capitalist systems work is a sound currency and sound real values. There's a moral dimension to this to me as well. 2% hits the poor the hardest because the poor are in a cash world and they have no way to hedge themselves against any inflation. So 0% inflation is the optimal from my perspective. The arguments for 2%, part of it I understand and agree with, which is we measure inflation poorly. And so there may be greater risks to deflation than there is to inflation. So if you're going to err, make the error on the side of very mild inflation. I'm in a group of corporate chief economists that meets 4 times a year. And so we actually, I'm responsible for doing a survey of them before we have our meeting so we can tee up what the issues are that they want to talk about. So we asked that question, would it be optimal to increase the rate of inflation to 3% or 4%? Economists don't agree on lots of things. In fact, there's a famous statement that if you lay all the economists in the world end to end, they won't reach a conclusion. But in this case, 90% said 2% is just fine. They were not in a favor of, and I'm in that camp obviously as well.
So any specific risks that are being identified and evaluated in the current economic environment?
Well, since I invoked geopolitics in the supply chain space, let's follow that for just a moment. I try to work hard and do things that don't keep me up at night. But I have to admit that the world right at the moment is a kind of a scary place. You have the war in Ukraine, you have the events in Gaza, you have the potential and the discussion of potential events revolving around Taiwan. The world is still a place that has evil in men's hearts. With all of those 3 things under pressure at the same time, it's reasonable for people who don't aspire to the freedom of their people to wonder whether the United States could carry on a 3-front war. That is, this is just Doug's, there's a disclaimer up there. Usually it says, this is to deny that Fannie Mae was ever there. But I think you have to think about the importance of those things because they are disrupting resource allocation, supply chains, all of those kinds of things, and they have the potential to get a lot worse. So we worry about that, and we try to understand where the pressures would come in terms of economic activity in the U.S. Frankly, defense spending is a direct contribution to GDP. So part of the reason the GDP growth as it is we've increased defense spending, which goes directly to GDP. So that's a contributor and will likely be a contributor for some time. Other things that we are concerned about is, of course, energy. That gets disrupted if something more serious develops in the Middle East. That will simply combine with the challenges about energy to Europe from Russia. That would be a high concern of ours. Disruption in supply to Taiwan is, we saw some of that in the auto industry with the difficulty of getting the chips that were required for production in the auto space. So disruptions there are of a concern. It's the rationale for the CHIPS Act, attempting to bring some of that production back on shore. We do worry that eventually the consumer is going to run out of powder. So we would agree with the Fed. We were surprised with the strength of consumers. We don't think it will last forever. We've seen credit card balances running back up. We've seen serious delinquencies. I've actually got some data in here. By the way, these charts can be made available to all of you. I'll come back to this chart. Get to the consumer. This is a chart that shows the magnitude. Above that red dotted line is the magnitude of transfers to households that showed up either as debt reduction or saving. Going below that red line means they're dissaving. In other words, they're spending out of savings. Then if you look, this shows you by quintile that the bottom two quintiles are seriously dissaving. The rate of dissaving in the other three quintiles is increasing, meaning consumers are spending those resources. Then if you look at where the level of debt is compared to pre-pandemic, it is back on, from a balance perspective, it's back to where it was before the pandemic. And then if you look at these are credit cards and auto loans, serious delinquencies are rising. So the serious delinquencies in the auto loans are back to where they were. In the credit cards, they're nowhere near the great financial recession, but they're back above where they were when we went into the pandemic. So part of the reason why we have the view that the consumer is coming under pressure and why we believe growth will slow going into the fourth quarter and into the early part of next year. So those are some of the things that we're watching. In the credit card space, it's not just the delinquency, but it's also, are they building balances, and then are they rolling balances over? If they are rolling balances over at interest rates, at today's rates, it is a sign of stress on the consumer side of the equation. But it's not distributed equally. As you saw, the two bottom quintiles are where the stress, most of the stress is. So at the upper income levels, there's still strength in consumption, but a lot of that is discretionary. So even if they have powder, they may choose not to spend it because they see other risks rising. So what are some of those other risks? Let me take you back to the chart I said I would return to. This chart. Typically, I do not show this chart until just before drinks are served. The red line here is a regression through the relationship between deficits and unemployment. When unemployment rises, deficits rise. When unemployment falls, deficits fall. Deficits rise when unemployment rises because people are losing income and not paying taxes. So tax revenues fall. And we have some automatic stabilizers like unemployment insurance and things like that, which are funded at a deficit. So that response to the rise in unemployment leads to increased deficits. When employment picks up, income picks up, tax revenues start to pick up, and the expenditures on those automatic stabilizers fall, and so you see deficits fall. What this is showing is that starting in 2016 through today, there was a radical departure from that relationship, which is where all of the government debt discussion is coming from, because all of those stimulus spending during the pandemic and subsequent to the pandemic are deficit funded. That has put us at a position where the debt to GDP ratio in the U.S. economy is the same as it was when we were fighting the peak of World War II. The question is, how sustainable is that? And it comes back to what I said earlier about the decision that you have to make about what's driving rates. Is it this chart telling fixed income investors we're going to require higher yields on treasuries because of the volume of funding that we're going to have to do because of the size of the U.S. debt and deficit. Now that's, there's not perfect proof in that, but it's a serious discussion. The CBO's projection of spending is that the interest expense on the U.S. debt is very nearly equal to our total defense spending budget, just the interest on that debt. So this is, from our perspective, something that's quite worrisome for future growth questions.
So I did see there was that uptick in the auto and the credit card.
Mm-hmm.
What is driving that? Is it unemployment? Is it what's going on over there? What explains that uptick?
One of the things that we learned in the great financial crisis was if you need to be able to drive a car to work to earn income to pay any bill, you may let your mortgage go before you let your car payment go. And what is it, OnStar? That's one of the things that's an alert or thing on your car. If you don't make your second payment, they might not let the car start. We haven't figured that out in housing yet. It's probably a good thing. But clearly, people were paying their car payment first because they had to get to work to pay any bills. Right now, the cost of automobiles has risen dramatically during the pandemic, and so those households at the lower 2 quintiles are under serious pressure, and that's part of the reason that those delinquencies are going up, is because to keep a running automobile, and you could see it both in new auto sales and in used auto prices. Prices rose dramatically. So it was just, we need a car, whether it's new or used, we need a car. So that rise in serious delinquencies in the auto space is, from our perspective, a reflection of that pressure on those households who haven't seen the income catch up to the price change in that basic fixed good that they use.
What challenges do you see in the housing market from a Fannie Mae's perspective going forward?
Well, affordability is number one. By our estimate, the share of a household's income that will go to servicing their housing-related debt is the highest it's been in, almost 4 decades. It's over 33% of their disposable income just for the housing. It's very high. The Barbara chart is it is a chart that looks at the relationship between the share of household income for median income households, or the relationship between median household income and median house price in a market to the interest rate on mortgage credit. And what you see is it's a very predictive line. From the early 1980s all the way out to 2003, that relationship stayed, from a regression perspective, for those economists in the room, it was right on line, extremely predictive. Then we saw the easing of credit conditions let the relationship between incomes and households go, the incomes way above. Then there was the bust, it fell way below. Then for 4 years, from 2015 to 2019, it came right back on that line. And then the pandemic blew it apart. So again, the vertical axis on this chart is median household income to median house price. So the verbal description of that is there's only so much you can afford to pay given your income, right? That's basically all that is it says if you have so many dollars of income, roughly 3 times a crude rule of thumb is you can afford a house, the price of which is 3 times your income. That's a kind of a rule of thumb. But it's moderated or modulated based on interest rates. So the higher the interest rate, the lower house price you can afford relative to your income, because more of that income is going to go to service the debt, right? So it's a kind of a common sense relationship. It turns out common sense is predictive, and almost perfectly predictive. Today, that chart, the combination of those things is far above that predictive line. So the question is, what brings it back in line? Well, interest rates could come down, and we think they will when the Fed eases, but they're not coming down to 2.5%. They'll come down. I'll talk about what we think that might look like. Incomes can come up, but the Fed's actually been putting some pressure on that because if they go up too fast, they make a contribution to inflation, or house prices can come down. And so that's why people were expecting house prices to come down, including ourselves, and they haven't. But that's a fundamental related to the population that are available on the demand curve and the availability of supply on the supply curve. And that's been put on the back of the builders who can't build fast enough to fill that gap, right? So how long does that chart suggest it will take to get back to, quote, normal? In the assumptions that we have in our forecast about the growth rate of income, the growth rate of house prices, and those elements that I talked about, it suggests 2028. So not soon, right? So affordability is going to be challenged for some time. Now, let me comment on where we think interest rates are going to go. So from World War II out to the year 2000, the average 30-year fixed-rate mortgage was 6%. So the unusual thing was that there was ever a mortgage rate under 3%, or really under 4%. During that time period where they averaged 6%, the average annual real, that is inflation-adjusted, GDP growth was 3%. The Congressional Budget Office does an estimate of potential GDP growth, and their view is today potential GDP growth is about 1.75%. So that would suggest to us that the run rate of mortgage rates would be lower than 6% because GDP growth will be lower than 3%, and there should be some relationship between those two things. Add in the scary chart I just showed on the size of deficits and the pressure that's going to place on the investors in securities, and I wouldn't expect a one-for-one decline in mortgage rates relative to GDP, but I would say over the housing cycle, from a low point of 4.5% to a high point of 6%, with a middle of maybe 5.25% might be a reasonable expectation for where mortgage rates are going to go in the future.
When you say in the future,
after the Fed locks down inflation at their 2% target.
And what are some estimates on when those in 2024, 25?
If you give a number, don't give a date. I also have rules on the question side, because if you ask me a question I don't like, I am from Washington, so I'll answer a different one. It's just saying.
All right, I'm going to wrap this up with the last question, and then we'll open it up for Q&A with the audience. What are some key new initiatives with respect to Fannie Mae that you guys are looking at and launching in next year or this year?
Well, we haven't said anything. I didn't say anything about the multifamily business, and we do a lot of business. I think we have, $400 billion or something like that of multifamily in our portfolio. So we're big in that space too. And one of the things we've been doing there is trying to collect information on rental payments as evidence that people are good quality if they want to move good credit quality if they want to move from an apartment to an owned home. Giving them credit for regular rent payments would be something that we could do. So we're trying to work on whether we can get a stable source of data on that to give people credit for good expense management at the household level. We're doing a lot of research on the single-family rental space. We actually have, I'll get the number wrong, north of $200 billion of investor-owned single-family residential properties. But it's been sort of by accident, and there's going to be more of that. So those Gen Xers who have locked in those 3% mortgages, I will argue that some of them will become investors because the payment on that mortgage is maybe $1,000 less than rents in that market. So if they're going to move, they'll keep that house, turn it into a rental, and use that difference between the rent payment and their mortgage to subsidize the mortgage, the place that they move to. or maybe they'll just use it as an income-earning property or something. So some of those which we took in as owner-occupied properties will actually become investment properties. So that's kind of how we got into that space. It wasn't an intentional product development, because we think you would have to underwrite that differently as a business than a single-family owner-occupied house or a multifamily rental property. And we don't really do that, but we're trying to understand the dynamic in that space and see whether over the longer term there's a reason to talk with our regulator about that space. One of the things that we know is that a significant chunk of that is very affordable rentals. And we do have a charter responsibility to support affordability, whether it's on the ownership side or the rental side. So we're trying to understand that something like 90% of those properties are actually owned by moms and pops that own, say, less than 10. But there's a chunk, there's also a small group of institutional investors who have gotten a lot of press, but in terms of the share of the market that they own, they're actually a lot smaller share of the market than people think. It's just that it's a kind of a new business development that's gotten a lot of attention. But there is that middle group where financing is not as stable, and they own anywhere from, say, 50 to 900 or 1,000 properties, and they're typically LLCs, things like that. So trying to think about, is there a stable funding that would augment that section of affordable housing? So those are some of the things that we're thinking about. I would say policy issues that are coming that are going to affect real estate, insurance is probably number one. The change in the climate change issue, we've started looking at it starting with flood. So about 6 years ago, I ran around the company and I asked, what do we know about the share of affordable housing in the United States that's at risk of flood? And everybody said, we don't know anything. The reason is because if a home is in a floodplain, it's the responsibility of the servicer to make sure that there is insurance on that property. And in the event that there is a loss, it's the servicer that will absorb the loss if there is not insurance on that property. So I started a process since it was relevant to our charter, and it was the collateral on which we depend behind the securities that we issue. It was business relevant. So we started with a horse race between two catastrophic risk firms to see how the actuarials line up to the actual losses, and it completely eliminated my confidence in the actuarial soundness of that space. So we've been working on that for some time now, and I think it will become a very big issue that will affect everybody in the housing ecosystem in one way or another. So those are some things we're working on.
Thank you so much, Doug. And as a token of our appreciation, this is for you.
Oh, thank you.
Yeah, as our
That's
second
beautiful.
leadership series speaker.
Thank you very
so
much. It's been a pleasure.
Thank you so much.
Thank you.
Thank you, everybody, for being here, and have a good day.